Today, we are taking a deep fundamental look at Oracle, ticker symbol ORCL, and answering one important question. Can Oracle become one of the biggest winners of the AI and cloud infrastructure boom? Oracle has transformed from a traditional database and enterprise software company into a rapidly growing cloud infrastructure provider. With cloud revenue growing strongly, OCI expanding rapidly, and remaining performance obligations reaching an extraordinary level, the opportunity is significant. However, Oracle is also spending enormous amounts on AI infrastructure and carrying substantial debt, which creates meaningful risks. In this analysis, we will look at Oracle's business, AI and cloud growth, financials, RPO, debt and cash flow, valuation, DCF, 2026-2027 earnings estimates, price targets, risks, and my final investment verdict. Oracle is one of the world's largest enterprise technology companies, with its core businesses spanning database software, enterprise applications, cloud infrastructure, and healthcare technology. For decades, Oracle's database business has been deeply embedded in large companies and mission-critical operations, giving the company a massive installed customer base and strong switching costs. But Oracle's growth strategy has changed significantly. The company is now using its existing enterprise relationships to move customers toward cloud services, while aggressively expanding Oracle Cloud Infrastructure, or OCI. This gives Oracle two major growth engines: recurring enterprise software and applications, and rapidly growing cloud infrastructure driven increasingly by artificial intelligence. The biggest part of the Oracle story is its cloud transformation. In fiscal 2026, Oracle generated approximately $34 billion in cloud revenue, representing around 39% year-over-year growth. Even more impressive was cloud infrastructure revenue, which reached approximately $18.1 billion and grew 77%. In the fourth quarter, OCI growth accelerated to approximately 93%. This is extremely important because it shows that Oracle's growth is increasingly being driven by cloud infrastructure rather than its mature traditional software business. AI is playing a major role because AI companies require enormous amounts of computing power, networking, storage, and data center capacity, and Oracle is positioning OCI to capture part of this demand. Oracle's AI opportunity is closely connected to its database ecosystem and multi-cloud strategy. Many large enterprises already depend on Oracle databases, and Oracle is increasingly allowing customers to use those workloads across different cloud environments while also offering OCI infrastructure. This creates an opportunity to benefit from the growth of AI without necessarily having to compete directly with Microsoft Azure or Amazon AWS across every part of the cloud market. Oracle's multi-cloud AI database business has also been growing extremely rapidly. If Oracle can continue winning large AI infrastructure contracts and successfully convert those contracts into revenue, OCI could become a much more important contributor to Oracle's long-term earnings and cash flow. Oracle's fiscal 2026 financial results were strong. Revenue increased approximately 17% to $67.4 billion, while GAAP net income reached approximately $17 billion. Non-GAAP net income was approximately $22.2 billion, and non-GAAP EPS was reported at approximately $7.63. However, investors should remember that fiscal 2026 included some investment-related gains, meaning the underlying earnings picture was somewhat lower than the headline $7.63 figure suggests. Even so, Oracle's underlying business continued to show strong growth, particularly through its cloud infrastructure operations. One of the most important numbers in the Oracle investment story is its $638 billion of remaining performance obligation, or RPO. Oracle's RPO increased approximately 363% year over year, which is extraordinary. RPO represents contracted revenue that Oracle expects to recognize in the future, so this figure gives investors visibility into future demand. However, investors should not treat $638 billion as immediate revenue or cash. A large portion of this backlog is connected to major AI infrastructure contracts that will be recognized over multiple years. The key question is therefore not simply how large Oracle's RPO is, but how quickly Oracle can convert that backlog into revenue and eventually free cash flow. Management's fiscal 2027 revenue target is approximately $90 billion, compared with $67.4 billion in fiscal 2026. That represents roughly 34% growth. Management also expects fiscal 2027 non-GAAP EPS of approximately $8.05. For my own estimates, I would use approximately $90 billion of revenue and $8.05 to $8.25 of non-GAAP EPS as the base case. In a stronger scenario, revenue could reach approximately $93 billion to $95 billion, with EPS approaching $8.50 to $8.80. In a weaker scenario, revenue could come in around $84 billion to $86 billion, with EPS around $7.50 to $7.80. This is the biggest concern in the Oracle story. At the end of fiscal 2026, Oracle had approximately $129.5 billion of notes payable and other borrowings, while cash was approximately $31.3 billion. At the same time, Oracle generated approximately $32 billion of operating cash flow, but capital expenditures reached approximately $55.7 billion. That resulted in approximately negative $23.7 billion of free cash flow. This tells us that Oracle is currently investing aggressively ahead of expected AI and cloud demand. If those investments generate strong future returns, this could ultimately be a very successful strategy. But if AI infrastructure demand slows, the debt and capital intensity become significant risks. Oracle expects capital expenditure to remain extremely high as it builds additional AI and cloud infrastructure. Management has indicated that fiscal 2027 capital spending could reach approximately $70 billion. This is the central financial debate surrounding Oracle. The company is essentially sacrificing near-term free cash flow to build infrastructure that it expects to monetize over many years. Investors therefore need to watch whether revenue growth and operating cash flow eventually catch up with capital expenditure. If Oracle can increase infrastructure utilization while slowing the growth of capital spending, the company's financial profile could improve significantly. At a share price around $150, Oracle's valuation looks considerably more reasonable than it did when the stock traded above $300. Based on approximately $8.05 of fiscal 2027 non-GAAP EPS, the stock trades at roughly 19 times forward earnings. That valuation is not excessive for a company potentially growing revenue at more than 30%. However, the major issue is free cash flow. Oracle's earnings growth looks attractive, but its current capital requirements are enormous. Therefore, I would not value Oracle based purely on PE. The company's future cash flow generation and the return on its AI infrastructure investments are much more important. My DCF analysis is more conservative because Oracle is currently spending heavily on infrastructure. Using approximately an 8.5% discount rate, a 3% terminal growth rate, strong revenue growth followed by gradual normalization, and an eventual improvement in free cash flow, my conservative DCF produces an intrinsic value of roughly $80 per share. However, this number is highly sensitive to capital expenditure assumptions. If Oracle's AI infrastructure becomes highly utilized and capital spending eventually normalizes, the company's long-term free cash flow could be substantially higher than today's levels. Therefore, I would treat the DCF as a conservative valuation benchmark rather than the only method for valuing ORCL. In my bull case, Oracle successfully converts a significant portion of its $638 billion RPO into revenue. OCI growth remains exceptionally strong, AI demand stays elevated, and infrastructure utilization improves. Under this scenario, fiscal 2027 revenue could reach approximately $93 billion to $95 billion, while EPS could approach $8.50 to $8.80. If investors are willing to value Oracle at approximately 25 to 27 times forward earnings, because of its AI cloud growth profile. I see a potential price range of approximately $220 to $240. My base case assumes Oracle broadly achieves management's fiscal 2027 revenue target of $90 billion and generates approximately $8.05 to $8.25 of non-GAAP EPS. I expect OCI to remain the primary growth engine, although its growth rate should eventually normalize as the business becomes larger. Applying a valuation multiple of approximately 21 to 23 times forward earnings gives me a base case price target of approximately $175 to $190, with $185 as my central 2027 target. The bear case is mainly about capital intensity and slower AI demand. If large AI contracts take longer to convert into revenue, OCI growth slows significantly, and Oracle continues spending close to $70 billion or more annually on infrastructure, free cash flow could remain under pressure. Under this scenario, I would estimate fiscal 2027 revenue around $84 billion to $86 billion, and EPS around $7.50 to $7.80. Applying a lower valuation multiple of approximately 15 to 17 times earnings could result in a price range of approximately $115 to $130. The biggest risks for Oracle are high capital expenditure, significant debt, negative free cash flow, competition, and the possibility that AI infrastructure demand does not grow as quickly as expected. Microsoft, Amazon, and Google have enormous financial resources and highly competitive cloud platforms. Oracle also needs to prove that its massive RPO can be converted into profitable revenue. If revenue growth slows while capital expenditure and debt remain high, investors could assign Oracle a lower valuation multiple. The most important numbers I would monitor during fiscal 2027 are OCI revenue growth, RPO growth, RPO conversion into actual revenue, operating cash flow, capital expenditure, free cash flow, and debt growth. The biggest bullish signal would be a situation where Oracle continues growing cloud revenue rapidly while free cash flow begins moving toward break-even. On the other hand, slowing OCI growth combined with rising debt and continued deeply negative free cash flow would be a major warning sign. My 2027 price target framework is straightforward. In the bear case, I see $115 to $130. In the base case, I see $175 to $190, with $185 as my central target. In the bull case, I see $220 to $240. This means Oracle has attractive upside potential from around $150, but investors must be willing to accept substantially higher financial and execution risk than they would with a traditional mature software company. My final rating for Oracle is hold, speculative buy. I like the long-term story because Oracle has strong enterprise relationships, rapidly growing OCI revenue, a massive RPO backlog, and significant exposure to the AI infrastructure market. The $638 billion RPO provides substantial future revenue visibility, while the company's cloud growth shows that its transformation is already happening. However, I am not giving Oracle a high conviction buy because of its approximately $129.5 billion of borrowings, enormous capital expenditure requirements, and negative free cash flow. Oracle is no longer simply a legacy database company. It is becoming an important player in the AI and cloud infrastructure market. The opportunity is enormous, but so is the investment required to capture it. If Oracle successfully converts its massive backlog into revenue, improves infrastructure utilization, and eventually brings free cash flow back into positive territory, the stock could move significantly higher. My 2027 base case target is $185, with a bull case of $220 to $240 and a bear case of $115 to $130. At around $150, I see Oracle as a hold for conservative investors and a speculative buy for investors who have high conviction in the long-term AI cloud growth story.